Assalamu alaikum everyone, welcome back. Today we will be discussing another topic in the financial accounting, that is accounting for partnerships. We have already discussed the theoretical discussion of accounting for partnership, that what are its characteristics, how many types of partnerships are there, and then how do we record the entries when a partnership is formed. Then after that, how to distribute the net income and the net losses of the partnership, and then what are the consideration we have to perform, or what are the things we have to consider at the time of liquidation of partnership. So that recording I have already uploaded. I'll advise you to listen to that recording before solving these exercises with me. So starting with some of the selected exercises from this accounting for partnership, financial accounting, chapter number 12. I have some random exercises over here which I will be discussing. The recording for these exercises you will find in two parts. Part one will discuss some of the examples, and then after that part two, which I will be uploading, that will have rest of the selected exercises. Starting with first exercise, which is exercise number 12-2. This is K. Decker, S. Rosen, and Itoso are forming a partnership. So are forming, they are starting a partnership. Decker is transferring $50,000 of personal cash to the partnership. Rosen owns land worth $15,000. They did not tell us that what is the value for this land. They just wrote here the worth. Worth means this is what currently it have in the market for the land. They did not say book value or what, so we always record the assets based on the fair value or the market value. So this is the land, 15,000. Worth means its value, and a small building worth $80,000, which she transfers to the partnership. So Rosen has brought land as well as building for the partnership. She didn't bring the cash, but non-cash assets are also the contribution by the owners. She also transfers to the partnership cash of $9,000, accounts receivable of $32,000, and equipment worth $39,000. Worth means not the book value, it means that the market or the fair value for the equipment, that is $39,000. The rule for accounting of partnership is that when a partner joins a partnership with non-cash assets, those non-cash assets are not recorded at book value, they are recorded at fair value or market value. The partnership expects to collect $29,000 of the accounts receivable. Now see here, accounts receivable which Toso brought, they were $32,000, but the expectations are that only $29,000 will be collected. So how much we expect not to collect? $32,000 were total, but we expect that only $29,000 will be collected. So $3,000 are doubtful, right? Allowances for doubtful account we will create with 3,000 because this is the expectation for the partnership. What we are supposed to do, instruction says that prepare the journal entries to record each of the partner investment. Number B says what amount would be reported as total owner's equity immediately after the investment. Now, in partnership owner's equity, all the capital accounts, capital of partner 1, capital of partner 2, and capital of partner 3, they are the one who comprise or who makes the owner's equity of partnership, right? So we will be listing all the capital accounts and we will get the RC. So let's start with the recording of journal entry. We'll start from Decker. Decker only bring 50,000 cash. So the partnership gets the cash. Cash gets debited here, and Decker's capital gets credit, 50,000 and 50,000. You can write the description to record the Decker's investment. Then Rosen wrote land and building. We already have their worth, means their market values with us, so we'll be recording it. Remember that if book values are given, please ignore that. We have to record the assets, non-cash assets, at their market values. Anyways, when we add these two amounts, Rosen capital is 95,000. Moving on towards Toso Capital, Toso brought accounts receivable, cash, and equipment. And don't forget that accounts receivable have here this allowances as well. So let's record it. Cash, Toso brought cash, so we debited here cash. He brought accounts receivable of 32,000, but 3,000 we expect that they are uncollectible, so we will create allowances for doubtful account 3,000. And equipment also he brought 39,000 was the worth of equipment. So altogether he brought the assets of 80,000, but 3,000 are uncollectible. So remaining his capital is 77,000. Part B, it's missing over here, but we will do it together because we just need to show that how much is the total owner's equity once the partnership is formed. So you can write here partial balance sheet. Okay, partial balance sheet. Then because we are only preparing owner's equity section, so owner's equity. Okay, firstly we have the current capital. How much is the current capital? That is 50,000. Then we have Rosen. How much is that? That is 95,000. And then we have also capital. That's 77,000. For the owner's equity. Okay, so you can write full totals owner's equity. Let's move towards next question, which is exercise number 12-3. Susie Hobart has owned and operated a proprietorship for several years. On January 1st, she decided to terminate this business and become a partner in the firm of Hobart and Sigma. Okay. Webhat invests in the partnership consists of $12,000 cash and the following assets of the proprietorship. So Susie has brought cash of 12,000 as well as the following assets. Accounts receivable, she brought 14,000, but there was allowances of 2,000. Equipment, 30,000, less accumulated depreciation, 4,000. Now, listeners, equipment book value we have to calculate, right? So equipment cost was 30,000 and its accumulated depreciation was 4,000. The book value of equipment is 26,000. Now remember the rule, we do not record the assets, non-cash assets based on, book value. We record them based on fair value or market value. Okay, so let's try this out. Anyways, let's move towards the remaining discussion. It is agreed that the allowances for doubtful accounts should be 3,000. She has recorded 2,000 in her books, but when they value, they came to know that not 2,000 out of 14,000, 3,000 are expected to be uncollectible. So this is the fair value, right? So we have to record allowances with 3,000, not with 2,000. The fair value of the equipment is 23,500. So we don't need book value, we need fair value, which is 23,500. Okay. What they want us to do, journalize Bupat's admission to the firm of Bupat and Sigma. So she brought cash of 12,000. She brought accounts receivable of 14,000. She also brought equipment with what? With the fair value or the market value, that is 23,500. Allowances for doubtful account are contra asset account, so it gets credit not with 2,000, with 3,000, which is the fair value for it. And then if you make a total, the total comes up 49,500, but 3,000 is uncollectible, so 46,500 is the capital of UPAT. Let's move on towards exercise number 12. Here, 12-4. McGill and Smith. McGill and Smith have capital balances on January 1st of 50,000 and 40,000. The partnership income sharing agreement provides for, so now their agreement, which is about, means that's partnership agreement, it says that the annual salaries of 22,000 for McGill and 13,000 for Smith. Interest are at 10% on the beginning capital balances. So we have opening balances here because it's January 1st, right? So on these balances, we have to keep them interest of 10% and remaining income or loss to be shared 60% by McGill and 40% by Smith. So whatever will be left over, that will be distributed. 60% McGill will take and 40% Smith will take. Prepare a schedule showing the distribution of the net income, assuming that net income is 50,000. So first we will prepare a schedule by assuming that the net income is 50,000. If you remember in the theoretical discussion, I told you always the salaries and interest is paid first, regardless the fact how much income is there, and then remaining net income is distributed according to the profit and loss sharing ratio. If there is a deficit, means there is no more income left, but actually there is a deficiency, that deficiency will also be shared according to the profit and loss ratio. They also want us to journalize the allocation of the net income in each of the situation above. So firstly, we will make a distribution schedule based on 50,000, and I will take you to part B to record its journal entry. Then we will make a schedule based on the 36,000, and then we will record its journal entry in the part B. Okay, so how this schedule looks like, this is how we can make the heading: division of net income. First column is for description, the second column is the first owner, the third column is the second partner, and the fourth column is the facts and figures of total numbers. Salaries allowance firstly. You can also, below this over here, you can also write net income, like an example they did. Sorry. $50,000. You can write it, and then after that you can start the schedule. Salaries allowance 22,000 and 13,000 for Smith. This data is clearly mentioned over here. If you see, where is it? Here, 22,000 and 13,000. And now we have to calculate the interest. Interest is 10%. So let's calculate for McGill. His capital was 50,000, 10% is 5,000. For Smith, his capital was 40,000, 10% is 4,000. Make a total. Total salaries allowance 22,000 plus 13,000 equals to 35. No need to write these symbols. I'm just writing to explain. Okay. Then 5,000 plus 4,000, total interest is 9,000. We need to see how much total salaries and interest so that we can calculate the remaining income. So if you see here, McGill has taken 22,000 as salary, 5,000 as interest. So he took 27,000. Smith has taken 13,000 as salary, 4,000 as interest. So he took 17,000. So altogether, salaries and allowances taken by the owners are 44,000. It means that out of 50,000, 44,000 is already taken up, right? Remaining income, which is 6,000, that should be distributed, right? So this is what I'm going to do here. Remaining income is 6,000. The calculations are shown over here. And then this 6,000 should be distributed among McGill and Smith. McGill shares 60% profit and loss. Smith shares 40% profit and loss. So 60% of 6,000 is 3,600. 40% of 6,000 is 2,400. So total income, which was 6,000, it is now distributed among the owners. So altogether, how much McGill has taken out of the 50,000? So he took 27,000 as salaries and interest. interest. Plus he also take 3,600 in the profit sharing. So altogether he took 30,600. Whereas Smith has taken 17,000 as salaries and interest, and he also took 2,400 as profit sharing. So altogether he took 19,400. So his complete sharing in the 15, it's the 50,000 which is shared now among the two partners. So now we can record the journal entry. Income summary account will get debit and partners capital will increase with these balances, right? So let's check the journal entry first. It's over here. Number one, income summary gets debit 50,000. McGill capital increased with 30,600, whereas Smith capital increased with 19,400. Let's make the second schedule with the second income which they have provided us in the question. So what was that? That was 36,000, right? So you can also write the same thing over here. This is division of net income. Below this, you can write net income. $36,000. Okay. So division of net income is $36,000. Again, starting with the same headings, salary allowance is 22,000, 13,000 for Smith, 35,000 is total. There is no difference as compared to the previous table, exactly the same thing. Interest allowance, I showed the complete calculation in the previous, so it's exactly the same. That's 9,000. Now total salaries taken by McGill is 27. Salary and interest taken by Smith is 17. So out of total net income, 44,000 is already taken. Let's see how much remaining income we have. So income was 36,000, but the distribution is 44,000. So we have a shortage. Shortage of how much? Shortage of 8,000. So where the owners share the profit, they also share the losses, right? Or deficiencies. So this should be shared among the owners. Total deficiency is 8,000. Again, the profit and loss sharing ratio are exactly the same. McGill 8,000 deficiency. Out of that, 60% is shared by McGill. Where profits and incomes increases the owner's capital, losses and deficiencies decreases the owner's capital. That's why it's in bracket, okay? 40% of 8,000 is 3,200. So altogether, 8,000 efficiency is being shared. So if you see, 27,000 he earned in form of salary and interest, but he shared a deficiency of 4,800. So his capital will ultimately increase with 22,200. Smith, he has taken 17,000 as salaries and interest, but he has shared a deficiency of 3,200, so his capital will decrease with this amount. So ultimately, he will share 13,800. So if you add these two figures, total 36,000 income is being distributed. Also, if you see here, total salaries and interest were 44,000, but 8,000 was deficiency. So the final distribution was for 36,000. So now we distributed the net income. Net income was 36,000. 22,200 is taken by McGill. 13,800 is taken by Smith. So let's record. Income summary gets debit. McGill capital gets credit. Smith capital gets credit. 22,200, 13,800, and 36,000 was the net income. Let's move towards the next question, which is exercise number Okay, this is exercise number 12-6. For national company, beginning capital balances on January 1st, 2017 are Nancy Penny $20,000 and Jody $18,000. During that year, drawings were Penny 8,000 and Jody 5,000. Drawings means the money which owners can withdraw from the business. Like net income or investments increases owners' capital, drawings decreases owners' capital. Net income was 40,000 and the partners share income equally. Prepare the partner's capital statement. So capital statement we will be preparing first, and then owners equity section we have to prepare. Okay. So partners capital shows us that what things have increased the partners and what things has decreased their partners capital. So increase comes from and net income. These things increases your partner's capital. What things decreases the partner's capital? Net losses, or you can say efficiency, and drawings. Okay, so let's prepare the partner's capital. National company gets debit, partner's capital statement gets, sorry, not debit, it's the heading, national company, name of the company, partner's capital statement we are preparing for the year ended, because whatever happened during the year, we're going to now put it in this statement. It's not on one particular date, it's for during the whole year, whatever things affected your partner's capital. So this statement is exactly like what we have in our income statement for the year ended, right? Not as on. Don't write here as on. That will be wrong. Okay. December 31st, 2017. Opening balances. Firstly, I will write the description column, then first partner, then second partner, and then make a total. So capitals on January 1st, it's given over here on the top, 20,000 for Nancy and 18,000 for Dottie. So 20,000 and 18,000. So total opening capitals were 38,000. Then net income, because all the additions we have to put first. So net income, they said they shared equally. So 40,000 divided by 2, 20,000 and 20,000. So add net income, 20,000 for Penny and 20,000 for Doddies. Altogether, it's 40,000. Then we have to make a total, and then we will deduct whatever things are for deductions. So total is 40,000 for Penny, and Dory has 38,000. So altogether total is 78,000. Less their drawings, Penny has 8,000 and Dory has 5,000. So I'm reducing the drawings out of this. Less drawings, 8,000 for Penny. You can write like this, you can write like this. It's up to you. Okay, you can put a bracket, but the thing is we have to deduct less it. So 40,000 was the total, but 8,000 are drawing by Penny. So his capital ending balance becomes 32,000. Dodi has a total of 38,000, but he has drawings of 5,000. So altogether, he has 33,000 capital. So ending capital balances are 65,000. If there would be any investment, so in addition area, I will also write here investment. Like in example, if you remember in the slides, we discussed one of the example. But in this question, we don't have any, so that's why I'm not writing. Okay. This is part A. Part B wants the owner's equity section for the balance sheet. So let's prepare that. National company, partial balance sheet, December 31st. You can also write here as on December 31st, 2017, but do not write for the year. That will be wrong. Okay, don't write that. Okay, let's prepare, because we are only preparing the owner's equity section. That's why I'm writing partial. It's important to write partial. Owner's equity, both owners need part capital, Nancy and Jody, both capital. A penny, this one, the one which you just calculated, this one, sorry, the one which you just calculated, 32,000 and 33,000. So total honors equity is 65,000 for this company. Okay, I have two questions which were segregated in the book, but I joined them because exercise number 12-9 was using the dataset of exercise number 12-8. So I added both of them into one question, and I added all the requirements over here. Okay, because one requirement was for 12-8 and the second requirement was for 12-9, but the data set was exactly the same. So let's do them together, because in journal entries are the one who help us in preparing the cash schedule. Okay, when you will read the question, you will understand what I'm trying to explain. So this company at December 31st has cash of $20,000. Non-cash assets of 100,000, liabilities of 55,000, and the following capital balances. Floyd $45,000 and David $20,000. So these are the two partners whose capital balances are also provided. The firm is liquidated. Liquidated means closing the business. and dollar 105,000 is cash in cash is received for non-cash assets. How many non-cash assets? 100,000, but we collected 105,000. So 5,000 is what? That is gain on realization, right? So that will be shared among the partners. Okay, Floyd and David income ratios are 60% and 40% respectively. So this is going to be shared 40% and 60%. I should say 60% and 40%. What are the requirements? Prepare the entries to record what? The sale of non-cash assets, the allocation of gain or loss on realization to the partners, and payment of creditors and the distribution of cash to the partners. So these are the steps we usually do for the liquidation, right? But they wrote it to make it easy for us. Let's start recording journal entry for the sale of non-cash assets. We don't have non-cash assets names, so we'll be using the same account title. Okay, so when you sell non-cash assets, they are removed from your books, right? So they get credit 100,000. But what price you receive? You receive 105,000. So 5,000 is a gain. Gain on realization will be immediately distributed to the partners based on their profit and loss sharing ratio. So gain on realization gets debit because now I'm distributing it. That was 5,000. 60% is shared by Floyd and 40% with David. So if I do this, out of 5,000 gain, 3,000 gain is taken by Floyd and 2,000 is taken by David. So gains increases, profits increases, owner's capital, right? So owner's capitals are increasing because of it. In part C, they want us to make the payment to the creditors here, and then they say distribution of the cash to the partners. So let's do point C. Where is it? Yeah. Liabilities gets debit and cash gets credit because we are making the payment, so liabilities will be removed, they will be finished. So normal balance of liabilities is credit. When we pay them, they get debit, right? So 55,000 and cash goes from our hands, so cash is decreasing credit. They say that always remember that before doing this step 3 of liquidation, which is this one, check out that is there any capital deficiency. Capital deficiency means if any partner's capital is in negative. If it is, then you have to consider that. But in this question, we have opening balances of capital. If you see here, we have credit capital balances. They didn't put bracket for us, right? So already the capital balances were credit. Also, with journal entry number 2, which is gain sharing, the capitals further credited. No debits happen. So we are sure that there is no capital deficiency. Moving on towards the final cash payment. So how much remaining cash is left? So I have to prepare the T account, right? So this is additional information. You can do it. It will make your calculations easy for payment. So opening balance of cash was 20,000. Then you get cash by selling non-cash assets, right? 105,000. So, and after that you paid to the creditors. So total of this was 125,000, but 55,000 get credit. So ultimately cash balance is 70,000. Floyd opening balance was 45,000, capital balance credit. He shared a gain of 3,000, so his capital balance becomes 48,000. And David opening balance was 20,000 and he shared a profit of 2,000, so 22,000. This is the gain. Remember, gain he shared in the second journal entry. So now I have 70,000 cash, which should be distributed among Floyd. Floyd will be taking 48,000 and David will be taking 22,000. And yes, this is together 70,000. Right? So we can easily distribute. So I'm passing this last journal entry, this one. Floyd capital gets debit because he is getting his money, 48,000. David capital gets debit because he is getting his investment back as well, 22,000. And the whole cash is paid off. Okay? Since we passed the journal entries, now it will be easy for us to do point number 2, which says that prepare a schedule of cash payment. So let's do that. It's over here, the big company schedule of cash payment, and then the items. Then you remember how we mentioned the accounting equation, cash plus all the non-cash assets separately. Even if in the question non-cash assets are separate, you have to add them, and non-cash asset will be mentioned one head for them in the cash payment schedule. I don't write here land plus building plus, no, it's not expanded accounting equation. I'm going to sell all the non-cash assets, and whatever I'm getting for that one time I'll be putting in the schedule of the cash payments. So that's why cash is the only asset which is mentioned separately, and all the non-cash assets joined together in one head is equal to all the liabilities together in one head plus the capital balances separately for each partner. This is how you mention your cash payment schedule. Okay, opening balances before any recording of the journal entry. Opening balances for everything given in the question was 20,000 was the opening balance of cash. We have non-cash assets of 100,000. So together they are 120,000 is equal to liabilities were 55,000. Fluid capital opening was 45,000 and 20,000 was debit capital. Then what we did? We sell non-cash assets. When we sell non-cash assets, they are removed from our books. So that's why I put this bracket to show a removal. Okay, they get credit. And here we get cash because of the sale of these assets. So this is debit, this is credit. So ultimate balance is 5,000. If you remember, we recorded gain on realization. There is no head of gain on realization. So we, in the second journal entry, we have distributed this gain among the partners. So that has increased the capital of Floyd with 3,000 and David with 2,000. So this is 5,000. So this is how I mention. We always mention the gain in the schedule of cash payment. After doing this, let's check what are our updated balances. So new balance for the cash is 125,000. There is nothing in non-cash asset. Liabilities are 55,000. Capital of Floyd is now 48,000 and debit capital is 22,000. Then third journal entry, we made the payment of our liabilities, right? So when we made the payment of our liabilities decreases. This is the credit side, right? So when the liability decreases, we debit them. So I showed a decrease with the bracket. Okay. At the same time, our cash also decreased. We credited cash. This is debit side. So when opposite action happens, we put it a bracket to show a decrease, and nothing other thing was affected because of the payment of liabilities. So now my new cash is 70,000. No more 125 because we paid 55,000. So now updated balance of cash is 70,000, and there is no more non-cash assets, no more liabilities. But yes, we have to honors capital. And then in the last journal entry, we made the payment, full payment. So whole cash was gone, whole cash was credited, and the capital balances were debited because we made them payment. So that's why I put the bracket. So ultimately, everything is 0, 0, 0. So this is final balance. And here comes the end of recording number 1 of chapter number 12. I hope these questions are clear to you. There is another recording which I'll be uploading soon, having 2 more questions along with 1 problem exercise for chapter number 12. Okay, students, I hope you understand these things. Please subscribe to the channel so that you get the notification whenever I upload the new video. Take care, everyone. Bye.